The word uncertainty appeared 16 times in the Fed chair's latest press conference, a fitting soundtrack for today's economic landscape. As consumer sentiment drops to a 2.5-year low and the 2-year and 10-year Treasury yields continue their decline, markets seem to be recalibrating. So the question is, will the Fed pivot or will they stick to their path of rate cuts? We're going to break it all down for you right here on UBS Trending. Hi, everyone, and thank you for joining me. I'm Anthony Pastori. This is UBS Trending. My guest back in the studio with me is Leslie Falconio, the head of taxable fixed income strategy for our chief investment office. Leslie, I want to get right to it with you because, as we're sitting here today, we just got all of the announcements of the retaliatory and otherwise 10% flat tariffs across the board from the Trump administration. And even before that, we were seeing consumer sentiment as one of several economic indicators that are nearing multi-year lows. So the question is, when you look at the soft data and then the hard data, does the soft data improve, or do you see that hard data kind of correcting even lower?
To your point, Anthony, although we don't know exactly what the duration or the depths, in terms of these tariffs might be, there's no question now the market's looking at, okay, that hard data is going to move lower towards that soft data. And I think it's really a lot of these second order effects that are going to impact the economy, in terms of simple demand destruction, in terms of what the consumer spending, which will lead to corporations pulling back on spending, which leads to therefore layoffs. And that's really the key that we're going to be looking at in terms of this hard data is layoffs and the employment. But if I had to say right now, given everything that we know and assuming that it's not reversed tomorrow, um, a high probability that that hard data starts to fall towards what we've seen in that soft data.
And I asked you this question earlier. The word stagflation comes up quite a lot because stagflation is an increase in inflation and a slowdown in growth. Is that something that's on the minds of you and our colleagues in CIO right now?
It's always on the mind, particularly when you see what we call the one-year inflation swap, right? If we look at these one-year inflation swaps, they've skyrocketed to like 375. Now, the longer-term inflation expectation, driven by tips, the break-even inflation expectation, the 10-year, is still around the 2.35. But the short end has really spiked higher, given the magnitude of the tariffs, and particularly given the fact that the tariffs that were announced yesterday were much greater than what the market was anticipating. So you have this really high spike in the inflation side.
Right.
Now, to your point, there's always this push me, pull me in terms of, is it going to be inflation? Is it going to be growth that really dictates the Fed's path? And our opinion is, that slowing growth, particularly if we see layoffs increase, is going to be the lead, and that will really dictate the Fed's path into cutting, over this year and into 2026. Inflation might be high for a short period of time, but it's really going to be when those layoffs start and you see sort of that labor market really start to loosen, then it's going to be that slowing growth that wins out, and the Fed in terms will react.
Speaking of the Fed, let's stay there because now we're looking at Treasury yields. The 2-year is right as we sit here, you and I, at about a 3.7. The 10-year is moving closer to 4%. So with that in mind, and you look at the 2-year yields, by the way, and they're even lower than the Fed's median year-end expectation for the Fed funds rate. What's your expectation for rates moving forward, and how would you be positioning portfolios in anticipation of maybe additional Fed action?
Yeah, I mean, look, we had a 4% 10-year Treasury yield by the end of the year. That's obviously been pushed forward, given the fact that the market is pricing in the expectation of slower growth due to these tariffs. So when we think about how the rest of the market will play out, look, more than likely, we are going to see that hard data, as we talk about, really start to slow. More than likely, we're going to see a pullback in consumers. More than likely, we're going to see a little bit of demand destruction. And although it might not be a huge amount of layoffs, we are going to see that labor market soften. So the fact that we've pulled sort of our year-end 4% 10-year forward doesn't mean that we can't essentially go lower. And that's really going to depend on what the actual data shows. Now, could we go back to, say, hypothetically, what we saw in August of 2024 of 3.5%? We absolutely can. But unfortunately, Anthony, here's the caveat. We could also move a bit higher if in fact some of these tariffs are sort of negotiated or if there's a reacceleration of the discussion of tax cuts beyond just the extension that might be a bit of stimulus and widening out that deficit, you could see the interest rates go up as well. So we've reached our target. Right now, I'd probably say, maybe, we buy on the dip. There's no question because our expectations growth was slow. But at 4%, I wouldn't buy here. It's a really tough place. We'd wait for interest rates to back up, but I wouldn't say we're necessarily done with yields going down. We just need to wait for the data. And when it comes to our positioning, Anthony, as you know, we've been really in the high quality sectors. It hasn't been the most exciting allocation these past couple of years, there's no question. But now is the time, particularly as we see this volatility and uncertainty, when those higher quality sectors really start to shine.
Yeah, and that you and I have been talking about that for such a long time, Leslie. That the high quality part of the fixed income asset class. So let me ask you: does any of this affect your asset allocation strategy? Because as we were just saying, traders are actually looking like they're betting on the Fed increasing rate cuts this year because you can just see the action on Treasury yields, particularly the 10-year, as we said, is now, as we're sitting here, close to 4%. Does that influence what your strategy would be in your asset allocation?
I have to say we've been a majority of high quality IG, MBS, 5-year treasuries, in that intermediate part of the curve, but we did have a bit of diversification in terms of having that floating rate because of the expectation that inflation would stay elevated, right? Now, when we look at that floating rate side, more than likely, it will not prove to be the hedge, if you will, that it needed to be if, in fact, the Fed remained on hold for a long period of time because we'd see this somewhat reacceleration of inflation. When it comes to lower credit quality, things like senior loans, we really need to pay attention to, the correlation to the equity market. Finally, fixed income like the treasury market and equity are recoupling, right? They're doing what they've done for years, which they lost track of for a while, but now they're recoupling again. So we're paying attention to that floating rate side that we have, even though majority of our sector is in higher quality in the intermediate part. But if in fact some of the data starts to slow and the Fed really starts to, signal that they're going to cut. I mean, again, the Fed is going to be more reactive than proactive, given what happened last September. But if in fact that data should show weaker, then we have to really start paying attention to that floating rate segment because it simply won't offer the hedge that it once did if in fact they stayed high for longer.
Great. Leslie, as we're wrapping up, with all that we've just talked about, what signals should investors be watching out for going forward? And obviously, that word uncertainty is still very prevalent. So given that, what should they be looking out for?
Look, it's really claims, labor, if in fact layoffs are rising, those are very, very important because that will really be the difference of the Fed taking action in terms of saying, okay, inflation's higher, it's gonna might even rise, right, because of these tariffs, even though it might not be for, a long period of time. But and them staying on hold versus saying, you know what, growth could really slow here. We're seeing layoffs increase. We're seeing claims rise. Not just a 1 month, but on a steady kind of basis. And when that starts to happen, you really have a tendency to snowball, and that unemployment rate could shoot to 4.5% or above, and then the Fed really starts to take action. So what you really want to pay attention to is claims, layoffs, the unemployment rate. We have a Friday, we have a number. Obviously, a lot of this data, a lot of this change won't come in till like June, July. That's why we don't think they're necessarily going to do anything in May. They're going to wait to probably cut the second half of the year. But those are the things we really have to watch out for because when that growth starts to slow, that will dominate the Fed's action, in our opinion, versus them having to deal with slightly higher inflation.
Right, and as you said right at the beginning, we'll still be on kind of the hunt and lookout for any information on what might be happening going forward with tariffs, if there's any
Absolutely.
reconciliations between the countries and the U.S. So there's a lot there, but thanks for giving us that sort of medium-term view on the markets. Leslie, always good to have you. Thanks for joining us.
Thank you.
Thank you. And for more information on everything that Leslie is talking about, plus the rest of our colleagues in the Chief Investment Office, you can visit our Insights website at ubs.com/views. Plus, lots more content from UBS is on social media. Check out LinkedIn as well as Facebook and Instagram. You can follow UBS Studios at UBS Trending. Lots of great content there for you. And as always, we encourage you to continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon.